Good morning, everyone. Thank you very much for showing up at 10 o'clock. I know it's early. It's early for me too. It makes me more happy to see some people at least in the room. We're going to do like 15 minutes of presentation, and then I have 5 minutes for questions if there are any questions. Let's dive into it. So I'm Andreas. I'm talking about Wildcat Bank's history of undercollateralized credit and why we need it on-chain, why it is important for DeFi to adopt the concept of undercollateralized credit. So let's start off with some history lessons. The challenge is money is very complex and it's very old, so there's like a bunch of stuff that I could talk about. I picked 4 examples about history and money that we know of, that maybe some people don't know, some people do know. If we look at the early medieval times, we can already see that the concept of credit was not unfamiliar to people. People that were traveling across the country, going into, for example, the Holy Land, had the challenge that they had to carry all their wealth, gold, silver, other valuables with them, and the problem was that they could have gotten robbed during that time. So the Templars basically created nice IOU systems where people could go to their castles, deposit their money, get an encrypted letter that they can then redeem at any other Knights Templar castle and basically get the money back in some way. This was, one of the first concepts of secure banking in some way. We see examples of Tether being a shadow US dollar reserve in some way, so a different type of money system that is not full transparent, or it is full transparent, depends on who you ask and who you trust. In terms of credit systems and credit history, we see Bank of Japan running multiple years of a very relaxed, credit system where there's a low interest rate, but it still didn't have the effect that they wanted to have. The cornerstone or the lesson learned of all of these examples is that the importance of how you create the credit system is based on the transparency and the flexibility. So you can design very good systems that are thought through, but if they are not transparent enough and they do not provide the flexibility to the individual users, they might not have the necessary effect on either the economy or the users that it's actually being targeted to. Now, one additional example is wildcat banking. Wildcat banking was a banking concept back in the Wild Wild West times of the United States, back when the West expansion basically was happening. The American government provided charters to companies to create banks that had very low regulation, also very low transparency, but overall it basically fueled the growth within the American state in the Wild West. So it was still welcomed in some way. The problem overall was that there was this like very small oversight to them. So let's dig into what they were truly. So one of the main advantages that they provided was they provided access to credit. So during the times where there was almost no infrastructure, no payment infrastructure, no banking infrastructure, people had the challenge that they wanted to expand overall. They wanted to, create farms. They wanted to start mining operations. They wanted to dig for gold. They wanted to start businesses, and there was almost no infrastructure for them to get credits or loans in some way. So Wildcat banks basically provided this capital to those people. It also fostered the innovation there, because getting access to credit basically allows you to do more than you can with the limited capital that you do have. And it overall expanded the money supply during that time, which is always important because increase of money supply means also more growth. The problem was that they failed, and they failed out of several reasons. One of them is a lot of them were scams. They basically just popped up took a lot of deposits in, printed a lot of paper IOUs, and then they just ran away. Due to the lack of accountability and the vast space between different wildcat banks and overall cities, it was really hard to get an understanding if these banks are still around, because the name wildcat banks comes from them being so remote that only wildcats roam around that area. So if I would be a customer at a wild bank, I would live, a couple of days on horseback away, and I wouldn't realize that the bank is actually gone in default after I traveled there on my own for another 3 to 4 days, because the rumors didn't travel fast enough just because of the lack of communication back then. No cell phone for them. They also failed because they mostly provided intransparent books, so they issued a lot of credit that they didn't actually have deposits with, which is fine if you do it in a way that it's still, in some way transparent, and you don't issue a significant amount more money than you actually have on your books. The interesting thought around wildcat banks is that it's very similar to what we're seeing in the beginning of crypto. It's like the beginning of banking area, the beginning of creating a new system that reaches people that didn't have access to the banking infrastructure before. So bringing back wildcats is interesting for us because most of the problems that they did have in terms of transparency, lack of communication, lack of information in general, we can solve with blockchain. Now, real quick, how credit expansion works in its most simplest way. Fractional reserve banking is what is basically the cornerstone of the banking system nowadays. We have a little bit of money that gets deposited into a bank, and the bank can make much, much more money out of it. So for example, if there's a 10% reserve ratio, a $10,000 deposit can basically be expanded into $100,000 in loan. And that's what we consider to be credit expansion and fractional reserve banking. Now, why is this important? Why is unsecured or undersecured credit important in general? It fosters overall expansion. So if you have a limited set of capital, you can only do the limited set of things that you can do with the capital itself, and you can never grow. If you only have $100, but you want to do something for $1,000, you will never be able to do this, except if you collect more money in form of loans or investments, etc. So the overall capital efficiency that we gain through this, by not necessarily needing to fully collateralize something or over-collateralize something, as we see in DeFi, for example. All of DeFi, all of the credit systems is mostly 120, 150% over-collateralized. It's just a very high capital inefficiency that we have in the system currently. It also bridges DeFi and the TradeFi system. So if we want to be a competitor to the TradeFi space, we need to adopt some of the concepts that they have to be able to basically scale. The interesting part, if we look at credit and MiCA, this is something that was very happy for us, and that's at least how we understood MiCA, is that as long as you don't determine that a credit needs to be repaid back into fiat money, so like actual euros, but you actually do any credit in ERC20 tokens, and the credit is also redeemable in ERC20 tokens, it does not fit into any MiCA regulation. So like you can still do the credit loans and receiving money from lenders, providing credit to other people without a MiCA license in any form, which is very interesting because if we look at stablecoins have basically one crypto. Most of the business that is being done today is done with stablecoins, just because they have the flexibility and the easy comfort of being stable in some sense. The problem is that at large scale, they're still not really stable, because if I just send around 5 USDC, it's pretty stable. But as soon as treasury managers, etc., start transferring a couple of millions in stables, there is a price difference and a slippage in some way which can hurt over time. So stablecoins, even if they're very comfortable, still not the ultimate tool yet to actually allow for a full under-collateralized credit landscape or payment vehicle, because there is still some arbitrage and some price slippage, but hopefully we'll get there overall. The challenge that we do have, and this is me basically also standing on a stage saying we need under-collateralized credit, it's the only thing that will actually allow us to scale and compete with TradeFi, is that we did have a time where we had under-collateralized credit on-chain already, or private credit, and it failed very badly. So if we look at the FTX collapse, overall, we had the problem that there was a capital flight because the hidden leverage that they had there was a lack of transparency, which led to a lot of loss of funds. We can see other examples of liquidity crunches, or we can see that there was just an overall cascade effect with 3 errors, where basically the transparency was not there of where the loans actually are, how much loans, what assets are the loans issued by. So the overall problem back then was that all of the credit pools that were on chain, they imploded suddenly and without any warning. Everything was very well and everything went very well up until the point where it didn't go well, and then it happened very fast without any indicators, any clear signals of which entities and which parties are overall involved. And this is also something that we're basically solving with Wildcat to bring more transparency into the system overall. The fundamental problem or the challenge that we still have in crypto is that we're competing with a $300 trillion market of credit in the real world versus crypto being 3.5 trillion. And there are some ways how we can smaller the gap. I mean, Bitcoin could raise to 10 million per share, or ETH could raise to 1 million per token, but that is something that probably won't happen tomorrow. So we have to find ways to smallen the gap in some way so that we do have a little bit more power and can compete with the TradeFi system. So we're kind of stuck in the dilemma that we have DeFi, we have very efficient technology, but the overall business practices that we do have on-chain are very capital inefficient. So we have like the dream that Satoshi gave us to have like a new system that can work fully independently from the fiat system, but we're kind of stuck in there because we're not using necessarily the right concepts, even though we're using the right tools. We want to distribute the traditional finance, but we're scared of using the most powerful weapon that traditional finance is offering us, which is fractional reserve banking. And we can see this because the current landscape of unsecured or undersecured credit basically is very bad on in the DeFi sector currently. Borrowers are dependent on centralized platforms that dictate the terms to them. The centralized platforms basically dictate the terms to the borrowers and to the lenders. And then there is also oversight in complex DAO votes that don't actually make sense. Lenders don't have the full transparency where their money goes to. So overall, the undersecured or the unsecured credit space on-chain is very bad at this time. This is where we basically came up with the idea and we created Wildcat. Wildcat is a platform where we launched last year. We launched V2 at DEF CON in February, and we've got about 150 million TVL up to now. The difference is that we are borrower dedicated. So borrowers can come to Wildcat and they can present what they want to have for credit. They can dictate what APR they want to offer. They can dictate what type of credit market it is. They can dictate what type of lender they are looking for. You could also see it as a Craigslist for private credit or a Tinder for private credit. The borrower basically needs to make him as attractive enough for lenders to be interested in providing capital to the borrower itself without frightening them off because it is in some sense unsecured, because it is under-collateralized or fully uncollateralized. It is the hope and the dream to make credits overall as flexible as DeFi swaps. And if we have the comfort and the ease of having credit as easy as a token swap, we can basically scale that into a much wider range than just having it over-collateralized in any sense. And this brings me back to the wildcat concept, or what wildcat banks are. If every borrower is able to issue their own debt tokens, so if, for example, in this case, Wintermute has a market, they accept USDC in their market and they issue debt tokens to the individual lenders. This debt token also has some value for the lender, but also for the wider ecosystem. So if this lender then can use the debt tokens that he has received from the Wintermute market and use that as an additional collateral in Aave market or in Euler market or being able to pay OTC on other exchanges with this debt overall, we can see the beginnings of fractional reserve and the multiplication effect that we have generally in the fiat system happening on blockchain and on Ethereum. This leads to the overall scope of Wildcat being a general credit layer, allowing for multiple types of credit, but also different types of use cases that we will expand over the next couple of years to hopefully grow on and under-collateralized credit to a state where we can actually really compete with the TradeFi space. Thank you for listening. We have 3 more minutes, so if there are any questions, now on stage or once I walk off, happy to also talk a little bit more. No questions. Thank you very much.